If you're running Roth conversions right now, there's a trap sitting in front of you that has nothing to do with taxes. And the strange part is how few people will ever flag it for you because they're so locked in on the brackets and conversion amounts that this one slips right past them. Here's the backdrop. Cerulli Associates found that 44% of retired households identify securing a comfortable standard of living as their top financial priority. Not maximizing returns, not leaving the biggest possible estate, but simply staying comfortable, protecting what they've built. A Roth conversion strategy is supposed to serve a goal: reduce future taxes, protect your Medicare premiums, trim your RMDs. But if it's built without accounting for this one detail, it can quietly gut the entire benefit you actually set out to build. Let me walk you through what it is and how to stay clear of it. Hi, I'm John Amarillo, president of Securus Financial, and I've spent years helping retirees work through the Roth conversion strategies, and I don't know how many times I've watched someone run a technically flawless plan only to have it blow up on them because no one mentioned this one detail. So today, the hidden danger that has nothing to do with your tax bill. We'll start with the trap itself, then how it can end up costing you more in taxes than you were actually trying to avoid in the first place. And we'll close with a simple way to make sure your conversions actually do what you set them up to do. So the trap. The trap is the 5-year rule. Now, before you tune out because you think you've heard this one, let me ask you something that trips up almost everybody. Did you know there are actually 2 completely separate 5-year rules for Roth accounts? Most people have no clue, and that's not surprising. Cerulli Associates reported in 2025 that fewer than 30% of retirement investors without an advisor feel very confident navigating decumulation and tax decisions on their own. The 5-year rules are exactly the kind of thing that gap is made up of. Mix these rules up, or just not knowing the second one exists can spring taxes or penalties that can undo years of careful work. Let me lay both out so you're never caught flat-footed. Now, the first rule is about earnings. Generally speaking, the growth inside your Roth can't come out tax-free until after 5 years have passed since January 1st of the year you first funded a Roth, whether by contribution or conversion, and you've hit 59.5 or qualify for some other type of exemption. Most people have a handle on that one. The second rule is where people get blindsided. This one's specifically about conversions, and it's the troublemaker. Every conversion you do starts its own separate 5-year clock. Not one clock for the account, a brand new clock for every single time you convert. And here's the bite. If you move money from a traditional IRA into a Roth and you're under 59.5, you can't pull that converted money back out without a 10% penalty until 5 years have gone by, counting from January 1 of the year you did it. But once you're past 59.5, that penalty on converted money goes away. It doesn't matter whether the 5 years have passed or not. So the conversion 5-year rule is a penalty problem for one group, and that is the people under 59.5. So let's give an example of how this plays out when it goes sideways. Take Susan. She's 57, retired early off a strong career, and she's got real money. A little over $2 million, most of it in a traditional IRA. She's been aggressive about converting $150,000 a year into a Roth for the last 3 years. Then life does what it does. She decides to help her daughter with a down payment and do a major renovation on the house. Call it $120,000 in this year. No sweat. She figures she's got close to $500,000 sitting in the Roth between her conversions and the growth. Except here's what nobody walked her through. She's 57. She's under 59.5. So that conversion 5-year rule is live on every dollar she converted. When she pulls out that 120 grand, the IRS has strict order for how the money comes out. Contributions first. Susan had about $20,000 in old Roth contributions from years back. That comes out clean. After that, it's the oldest Roth conversion first. Now, her oldest Roth conversion was only 3 years ago. So none of her Roth conversions have cleared the 5-year benchmark. And because she's under 59.5, every dollar of that conversion that she touches is subject to a 10% penalty. So she takes out $120,000, 20 which is covered by contributions. That's $100,000 coming straight out of conversions that haven't aged 5 years. That's $10,000 in penalties alone. Gone. A tip to the IRS over a rule that nobody ever explained to her. Now, flip one variable. Let's say Susan's 62 instead of 57. None of those penalties happens, regardless of when she converted. Now let's talk about the earnings timing trap. Turning 59 and a half feels like the finish line, but it isn't. There's a second clock running, and if you miss it, well, don't worry, the IRS is waiting. So picture this. You're 63, and over the last 2 years, you've converted $100,000 into your Roth. The accounts have grown incredibly to $150,000, and now life happens and you need $105,000 for something big. Here's what the IRS ordering rules say comes out and in what order. Regular contributions first, then again, those conversions oldest to newest. But then there's a third level, and that's earnings, which come out last. In our example, there are no regular contributions, just conversions. So the first $100,000 you pull is your conversion basis. Clean, tax-free, no drama. But that last $5,000, it has to come from earnings. And earnings play by a stricter rule. For earnings to come out tax-free, you need two things true at the same time. You have to be older than 59 and a half, and 5 tax years have to have passed since January 1st of the year of your first Roth contribution or your first conversion, whichever came first. But you've only been on the clock at this 2 years, and that clock isn't done. Miss either one, and the distribution isn't qualified, which means that $5,000 of earnings lands on your tax return as ordinary income. Now let me make this crystal clear. In this scenario, you are not subject to a 10% penalty. But you took tax-free money and made it taxable. And that income tax bill is real. IRS publication 590B lays out the ordering rules. Contributions, then conversions, first in, first out, then earnings. And the qualified distribution rules live in section 408 of the code. I know I sound redundant, but this is important. One clock for the age, one clock for the 5 years. Both have to ring before earnings can come out completely tax-free. And most people are surprised how fast this outgrows what their tax software can handle and why most people miss it. And here's the part that should give you pause. Cerulli Associates found that 71% of pre-retirees have not sought advice or planning help from any advisor or retirement account provider in the past year. That's not a gap in information. Information is everywhere. That's a gap in guidance. Someone who's actually running the movie forward 5 years to see what a withdrawal looks like down the line, not just optimizing this year's tax return. The 5-year clock is a future problem, which means it's exactly the kind of thing that slips through the cracks. So should you skip conversions altogether? Not a chance. Conversions are still one of the best tools in retirement planning for tax management. The goal is never to avoid them, it's just to do them in a thoughtful manner with your eyes fully wide open. And remember, Roth IRAs just don't have living benefits like tax-free income and reduced exposure to required minimum distributions. They're very powerful for survivorship, spouse planning, and estate planning. So how do you protect yourself? Well, I suggest building a conversion calendar. Map out when each conversion actually frees up. Converted $50,000 this year, write it down. The clock on that starts January 1 of this year. Do it for every conversion so you know exactly when each slice of your Roth IRA is genuinely yours to spend without strings. Keep your emergency money completely outside the Roth. Folks get fired up about converting and shoveling everything into a Roth, leaving nothing liquid outside of their retirement accounts. The entire point of a Roth is to let it sit and compound tax-free. This is the most powerful type of money, and we want to access this money last. Let its power multiply. The minute you're forced to rate it because life happened, you've undercut the whole reason you did it. Next is pressure test the strategy before you ever need it. Ask, what if I need this money in a year or 2 or 3? Run the real scenario. Figure the penalty if you're under 59 and a half, and figure the tax on earnings if the 5-year rule isn't met. If those numbers make you wince, well, that's your signal. Convert less and keep more where you can actually get to it. Lastly, here's an important approach on Roth conversions I take with my clients. Now, the software gives us an optimal number of what we should convert. That number often sounds great, but then we take a secondary software and we price out the cost of that conversion because you're writing that check and you need to know exactly what it costs before you decide. Now, if that number feels like too much, well, we just adjust it. You choose what you're willing to pay, and we build the strategy backwards from there. That's how a conversion becomes something that empowers you, not something that stresses you out. Now, here's the bottom line. The 5-year rules aren't complicated once somebody actually lays them out for you, but they don't forgive, and neither does the IRS. You can nail every bit of the tax side, perfect brackets, IRMA handled, future RMDs trimmed down, and still walk into penalties or a tax surprise bill if you need that money before the clock's up. A good conversion strategy was never just about how much to convert or which brackets to fill. It's about making sure the money you're converting is money you can leave alone, especially for at least 5 years, and especially if you're under age 59 and a half. That's the part software misses. That's the part most people overlook because they're looking at a tax return, not their actual life. Most people come to us thinking they need a bigger number. What they actually need is a clearer strategy, one built around what they might genuinely need and when. So if you want a conversion strategy that accounts for all of it, not just the tax math, but the timing, the liquidity, the what ifs, then book some time with me. The link's in the description below. See you in the next one.